In DC, for DC. DC Radio, 96.3 HD4 and DCRadio.gov.
Welcome back to another edition of Champagne and Credit right here on DCRadio.gov at 96.3 HD4. I am Muriel Garr. You know, it's those three numbers that millions of Americans just worship. And up until now, those numbers have actually been going up. They're at an increase. But there's something that's getting ready to happen that could impact where those numbers go. What numbers are you talking about, Muriel? None other than that infamous credit score. You know, the ones that you love to tell everybody about, the ones that are more important than actually your net worth or how much money you actually have in a savings account? Yeah, those three numbers. Well, joining us in the studio today are two individuals that are going to share with us exactly what's getting ready to happen with those three numbers and how they may impact you. So joining us in the studio today is an individual that's no stranger to Champagne and Credit. She's none other than Shahidah Williams, the founder of Shahidah Speaks, a seasoned professional not only in the financial services sector, but also she's a licensed attorney. So this sister has her act together. And sitting next to Shahidah today is a gentleman by the name of Flemming. He is new to Champagne and Credit, but he's coming to us with an enormous amount of expertise in the field. He's a financial services technology executive that is a longtime consumer ally and resident of the District of Columbia. He works as the director of consulting at Experian, but on this show, he's not representing Experian, so let me give him that disclaimer, but he is bringing his wealth and breadth of expertise to this topic. Shahidah and Perry, welcome to Champagne and Credit.
Thanks for having me, Muriel.
Thank you for the invite.
You are welcome, Perry. Don't worry about it. You'll be safe. Maybe, Shahidah says. So let's just jump right into it. I'm going to start with you, Perry. Although you're not representing Experian on the show today, could you tell our listeners who is Experian and exactly what do they do?
Yes, thank you for the invite, and grateful to be here today. So Experian is one of three of the credit bureaus. The way I like to explain them is they collect data, analytics, and they use that within technology to provide both businesses as well as consumers their credit score. Fair Isaac is the owner of the actual FICO score that is utilized as far as the technology and that owns the actual score. But the three credit bureaus, Experian, TransUnion, and Equifax, are the suppliers of all the ingredients that go into the FICO score.
Now, you said that Experian actually works for both consumers and for businesses. How is that?
Yes, so once a year, consumers can get a copy of their credit report. The credit report has the data associated with their payment history as well as what debt they have outstanding. And that information is utilized by businesses as well as employers to make decisions about extending credit or extending employment or other lines of businesses as well. So both the consumers as well as the businesses have a benefit of what the credit bureaus do.
So what role does Experian actually play in the credit market?
So Experian collects the data on behalf of the consumers and the businesses, and they supply data, analytics, and technology to the financial services industry, of which is utilized for decisioning, for marketing, for servicing of all lines of credit. So whether it be mortgages, auto loans, student loans, etc., the data that's utilized in those industries are provided by one of the three credit bureaus, as well as several other companies that provide data.
And so you said that Fair Isaac, actually, which is FICO, they actually own the model. And so how many FICO scores are there?
Too many to talk about in this short show. So every line of business have different FICO scores that's leveraged. There's also different iterations of the FICO score. So I think right now, most people are leveraging FICO 8. In most lines of business for personal loans, credit cards, auto loans. In the mortgage industry, I believe it's still being leveraged FICO version 4 or 5, which is a couple additions behind what we're going to talk about today, which is FICO version 10.
All of these versions, though, look at consumer behavior differently and then impact a consumer's ability to actually engage in credit activity.
The way I think about it is data analytics technology evolves over time. It's been a huge pickup in how data can be leveraged today, leveraging big data analytics and trended data. So just like if you talk about a version of a car or a version of shoes, there's new technology that's put in that car that is rolled out from 2005 versus the newer model in 2020. And every year there's new technology that's being added to the data analytics that's associated with FICO.
So, Shahidah, you've sat patiently as I've, tried to drill Perry down, but, he kept using this terminology, data analytics. And when we're talking about people in neighborhoods or who are just trying to get access to capital in order to obtain some basic things, whether it be housing, whether it be transportation, or actually getting a job, are they thinking about data analytics?
No, but I think Perry had a fair but very technical explanation on how the credit system works. But as a consumer advocate, I like to talk to people about like where they live, and I think that's what's subsumed in your question. What I'd say is the credit report and credit score are your adult report cards, and they're in the center of the room when you come to the table with a lender to borrow money. The lender's wondering, is this person going to pay my money back? Because, everybody promises to pay when they want a loan, right?
Definition of credit is a promise to pay.
That's right. And then you have the borrower on the other side saying, am I going to get approved? And how much is this going to cost me? So the credit report is a culmination of your payment history, how much you borrow, how much debt you have, and so forth, to show your responsibility with prior credit, because that's a good predictor of future ability to borrow the credit in the same instance. And then the score is kind of a quantitative measure of that, and that helps facilitate a conversation between the lender and the borrower, and determine how much it's going to cost if the lender wants to extend an offer, and that's objective versus. We know that it used to be a handshake, or where, dad used to do business, and whether or not they would do a loan with you. And we know what's wrong with that historically is, it's a rife, playing field for discrimination and disparate impacts that we've seen. And credit is so important to business development and home ownership and asset building in general. So I would say that data analytics in and of itself is important, but that's more of a backdrop issue. What's a kitchen table issue is paying my bills on time, keeping my debt low, managing my budget effectively, and living below my means. And, for lenders, they're worried about, the risk of you not repaying. So if we keep it simple, data analytics really is the very technical and sophisticated measures by which those things happen that facilitate that, and to try to make it as fair and objective as possible. But I think if we keep it surface level in that explanation, I think that might be, I don't know if you agree, but I think that's a fair explanation on how things work as it relates to what Perry said and where I think most people are thinking.
So you wanted to keep it simple. You want to use the kiss analogy here. And you said it was simple as paying my bills, paying my bills on time, et cetera, et cetera. But I did ask Perry a specific question, and it was, how many FICO scores are there? Because it's not as simple as paying my bills. And it really isn't as simple as that pie that we teach people about and how they determine exactly what their score is. And particularly if we think about what's getting ready to happen now with FICO 10, because the score in that pie is, who you owe, how long you've owed them,
whether you pay them on time,
whether or not you pay them on time. But there also are different weights within those slices of the pie that impact those various FICO score models. Is that not correct?
That is absolutely correct.
And so that's not an average kitchen table conversation. And it's not as transparent to most people. So we've been, as an industry, going through this whole financial education crave, and Perry, you talked about, it's like getting a new car. So we've gone from the Yugo to, what was the next iteration. And I know you're looking at me, you're like, who was driving? And you go, and Muriel, you're really dating yourself. But, just roll.
I think my grandma had one.
Just roll with me for a
I'm
minute.
not going there.
just roll with me for a minute, okay?
I'm winding down the window.
You winding down the window? Okay. So I didn't go back to the horse and buggy, but we've gone from that to another more up-to-date model of transportation. And so consumers who have been engaged in not only just classroom education, but now you can Google anything, have learned that, if you do certain things, you can help to control what that score looks like, putting yourself in the driver's seat, because we know the higher the score, the lower the cost of credit. So they've learned how to play that game. And so recently we've seen scores like just going up. And there's a particular credit service model that, if you enroll in it, they'll basically tell you, hey, if you make these payments, your score will go up. And as a matter of fact, if you get a personal loan and pay off your credit score or pay off your credit cards, you'll see your score go up 50 to 80% or 50 to 80 points. Those same individuals with this new model are going to see their scores actually go down, because this new model is looking at what's happening with their unsecured debt.
Yeah, well, weighting it more heavily. But the if is a big if, because which model is being used is determined, of course, by the lender, right? They're going to decide according to their credit policies.
Lack of transparency.
Right, which model they want to use. But Muriel, if I can kind of...
I need you to answer that. Lack of transparency, because when you apply for credit, the lenders tell you which credit bureau they're actually going to pull from, but they do not tell you, nor are they required by law to tell you which model they're going to use.
That's true, but according to the Truth in Lending Act, right? According to the Truth in Lending Act, Regulation Z, which is on the books, right? Regulation Z stipulates that they have to tell you what score number they're using, maybe not the weight, but what score they're using to determine your eligibility for a loan, right?
They'll tell you what score you're using, and then you engage, and you'll go
at the table before you decide to accept the credit, right?
They'll tell you what score, right? But they'll say, this is the score that we're using to determine your eligibility for credit.
Yes.
And you're going to look at that score and you're saying, well, wait a minute. When I checked my score was this. What is the difference in the score?
Because one's a consumer score and one is the lender score.
Lack of transparency.
Well, I don't know.
So how is this a kitchen table conversation? It's not as simple as me going to work, me engaging in this relationship, me struggling to pay my bills on time, actually without negating saving, because I've been told that score is so important.
Well, Muriel, and this is your show, so I'm going to let you have your moment.
Come on,
but I noticed on the table there you have an iPhone. Which iPhone do you have there? Which generation do you have?
Now, see, you wanted to really take me there. So people that know me would say that she doesn't even know how to halfway use this phone.
Well, don't back away from the question now.
I don't even know what version.
Okay. Well, pick a number.
Suffice to say, since I've had it like 7 years.
And we're on what, 10? The 10th generation of iPhone?
So the other,
that's not a 10, right?
This is nowhere near a 10.
Okay, let's say it's a 7.
Because it's not a 7 either.
Let's say it's a 7, and I have a 10 over here. Can I still send you a text message?
Where are we going with this, Attorney William?
What I'm saying is that iPhone is iPhone, and we can have a conversation about some of the different features.
But Attorney
and benefits.
Williams, I object.
My goodness.
Your Honor, I object.
Either you're going to ask me,
because a score is not a score. A score is not a score. You're trying to do a parallel there. A score is not a score.
I'm in the analogy business.
Oh, analogy? Okay.
We're trying to help listeners understand this credit game out here.
And I'm saying that you said it just correctly. It is a game, and
yes,
it is a hustle, and it is not necessarily put in a place where a consumer can control their destiny.
That's true, but what I implore your listeners to consider is that credit is not necessarily the game you want to get in the first place. I've been on your show before, Muriel. You already know I'm the cash is king.
Well,
you already know
I think that.
You already know that I don't think credit is the central tool. I think that the budget and your cash flow are the central tools. It's just like I always use the analogy, I'm in the analogy business, of building a house. It would be ridiculous to think that the hammer is the only tool that you need to build a house, even though I'm quite sure I've never tried to do it, that you need one to build it. But the essential part is the wood, right? It's the actual frame.
No,
so the cash,
essential part, no.
And the cash,
the essential part
and
is
the budget,
actually the foundation.
Right.
And so what you're saying is
the
budget
wood is the foundation of a house, right?
No.
No. Well, you need to call your engineer and check
the wood
your
is not the
survey
foundation.
and make sure your house is standing.
The wood is not the foundation.
It's gonna blow
the foundation is actually the soil of the ground in which the wood is actually, or that foundation of cement is poured into on which the wood is built on. And I think what you're saying is the budget is the foundation to our financial success.
Absolutely. I'm trying to say that.
But the credit score
is the hammer. Is that nails all some of these things together. I mean, I live in and of the world, Muriel. Come on now. I used the loan to buy my home.
But
used a loan.
You are educated and you know the difference between FICO 4, FICO 5, FICO 7,
but
FICO
it
10.
never mattered to me when I went and borrowed. You know why? Because
Perry's he's shaking his head because he's saying, so Perry, do you know the difference between those models?
I at a high level know a difference, but the ingredients that's going in to make the score range, the predictor, the algorithm is relatively the same. It adjusts over time based upon the new data that can go into it, and also across different lines of business. But generally speaking, if you have an 820 on one score, you're probably going to have an 805 on the other score.
So I'm talking about
an iPhone is still an iPhone.
But the same
regardless what generation
same
you
concept,
have. Is that
if you're
what
on
you're
the lower
saying?
end of those scores, it's still going to be relatively the same. So you talk about the shift to version FICO 10. It talks about for the large majority of consumers, the shift up or down is going to be within 20 points. That 20 points not really going to make the large majority of the decisions on whether or not you're going to get credit. It may influence, how much interest rates is actually charged on that loan. But most of those borrowers that were able to get approved previously will be able to get approved now.
But it's not. So Perry, you just said something. It's going to influence the interest rate that you're going to pay on those loans, the cost of money. And so here's this thing that I say when I'm in the teaching realm, that interest is one of those interesting words. Interest and compounding. They work on both sides of the balance sheet.
Agreed.
When it's going out, you're helping somebody else achieve their goal. When it's coming in, you're helping yourself achieve your goal. So 20 points is a difference in whether or not you're going to be able to save the money that you need for retirement at the time that you want to. It's the difference in whether or not you're going to be able to help your children go to college. The difference in whether or not you're going to have the funds to actually pay for a burial of a family member. Because interest impacts particularly the Black and brown community.
That's kind of true, but then also
That's kind of true?
Well, I'm saying that it's kind of true because, yes, interest is the cost of money. Yes, there's a such thing as risk-based pricing. But also a 20-point difference in your score, a 700 versus a 730 with most companies is probably going to be in the basis points of difference.
So both of you are using 700 and 800 ranges when that is not the range.
Because the average credit score right now is 702.
700.
But that's not the average score for the African American.
Okay. I will agree with that. And I don't know what that data is. But the point is that even if the cost of credit becomes a little bit higher or is higher, that information of how much you want to pay for the loan according to the Truth in Lending Act is still going to be useful to the borrower to determine if they can afford the loan. And affordability also relates back to the budget, right? Before you sit down with the lender, you want to decide how much home you can buy. You want to decide how much monthly payments you can afford. And very few people are doing that because they're worried about where their credit score is only. And so what I'm saying is the conversation needs to be more robust, because also the people who keep their debt low and manage their budgets effectively tend to be the people that Perry was talking about with the 700 and 800 scores, right? And so you're right. I think that credit is important. Credit can be expensive if you don't know what you need to know. But I think that having a holistic approach is going to be more ideal than just focusing on credit, because the logical conclusion to focusing on credit is getting loans, and loans equals debt.
So you did bring up Black and brown people. I just want to throw one thing out that's going to come out with this new model of FICO version 10. There's a version 10T that uses trended data, which is beneficial for a lot of people that have low credit scores, that's looking to improve their credit scores, or people that have what we call thin files. So consumers, millennial consumers, or
so
immigrants.
let's break down what a thin file is for our listeners, because they're not going to understand it.
So thin file is I don't have a whole lot of data on my credit report today, or this is my first time getting data. And so what trended data is allowing the credit industry to do, as well as the banking industry, is instead of taking a snapshot picture of a person's credit, and that's what traditional credit scores have been based on in the past, it's allowing a videotape of somebody's credit. So trended data allows us to look at not just what's happened this month when we're looking at your data, but it's allowing us to look at what's the trend of that data.
How are you doing?
Over a period
How is
of
that
time.
going to play in a thin file scenario? Because in a thin file scenario, you're new to the credit market. You have one or maybe two actually credit lines, and you may not have any credit lines at all. So it's going to look at alternative reporting, such as utility bills, telephone bills, or even library cards. Which is actually some ways that mortgage lenders actually look at alternative credit for thin files.
Yep, I just want to make sure we separate the two. Alternative data being a very important development in the credit industry, but trended data is specifically looking at the exact same thing that's been on your credit report all along, but looking at it from, instead of a one-time snapshot perspective, day over day over day, looking at the video surveillance camera of what's happening with that actual.
So how is that helping
So what it allows it to do is to create more data that can be put into the model that can score somebody's credit score. So if you get new credit today, it's going to take months at a time before you get enough snapshots for it to be able to score somebody with a FICO score. Whereas if I look at you on a daily basis instead of a monthly basis, or if I look at, well, today she had it at she got 500 on her credit report. I mean her credit loan. She paid it off $50. Then she got another $100. Then she paid off $500. It just tells me more about the trend associated with your loan.
So it's only going to help someone in a thin file scenario if they have credit. They've got to have at least one credit line, and they're going to have to be using it.
Yes, one credit line is the bare minimum for any score.
And I see a detriment to that. If you're somebody like me who puts everything on one account and then pays it in full at the end of the month.
Every 30 days.
Or
before the bill drops.
That's going to, I might need to give myself a short-term loan for an emergency, and now.
Or get in the habit of every time you charge, then at the end of the week, make a payment.
Well, see, now we're in the weeds here, right?
We're in the weeds now.
Now we're in the weeds. No, but I mean, that's what would be required. I mean, that's the consequence, I think, of a 10T model should a lender adopt it. But understand what's happening practically. When you sit at the table with a lender, whatever model they use, they're going to tell you what score they're predicting, that they're using, and they're going to tell you what that means in interest. And then they have to tell you what that means in finance charge, right? Truth in lending, right? They have to lay all of that before you. And now the borrower gets to decide, do I want this deal? So irrespective of what models use and so forth, there's still now a very critical decision that needs to be made. And that's a kitchen table decision, right?
You know, you sound so logical. And if I did not respect you as the black diva that you were, Girl,
I don't like that word, diva.
Well, you may not like it, but
Lord have mercy.
If I did not respect you, I think I would chop you up, and I'm still gonna have to chop you up.
Please
because
do. Challenge me, Muriel.
Here is the reality, particularly in underserved communities. They're not going to be sitting there having this negotiation with a lender when it's time to get a loan. They're going to be just happy that they got their loan approved.
And I'm challenging that thinking.
Well, you can challenge that thinking all day long, but when we have been so financially enslaved for so long, where we have been void of access to capital in a capitalistic society where we can engage in thought-provoking conversations about why you should give me this loan, and by the way, why are you charging me this interest when you charge that person that interest? It is not that simple.
Sure it is.
And I think, no, it's not. And I think we have to be mindful, because it was interesting with FICO 10, some of the things that the previous president, who was the smartest president, put in place is that things like medical bills, it's my show, student loans.
That's why I giggle.
And the other derogatories would not have as huge of an impact on the score. Now, from what I've read with FICO 10, that's sort of being erased, and now that's coming back into play.
Assuming that the lender adopts that model.
And so if the whole purpose of money, which is a business, is to make money, and if consumer scores have been going up, which means because the risk attached to the score, the rate to borrow should be going down, which means the ability for the lender to make more money has actually also gone down. Let's change the model so that the scores will decrease, so I can charge more in interest, so that I can actually make more money.
So Muriel, I want to put a pin in that, because
Perry
I also want to. I also want to talk about. I want to talk about vulnerable communities, but I also want to talk about models and the flexibility of lenders to adopt them, because the biggest purchaser of an offer of liquidity in the market is going to be Fannie Mae, and Fannie Mae has guidelines for what type of scrutiny and what type of credit the borrower needs to have in order to purchase the paper. So we'll talk about that in just a minute.
But
talking about vulnerable communities. Can I go back to vulnerable communities for a second?
Because the producer's looking at me and saying, check the clock, you got like 3 minutes. So, but it would be...
How convenient.
You said earlier, it is my show.
It's your show.
But Fannie Mae is dealing in paper associated with real estate and
mortgages.
Real estate, mortgages.
Freddie Mac, same thing.
Fannie, Freddie, Ginnie Mae, all three. But what's impacting the consumer right now is not secured debt. It's unsecured debt and student loans. And so, I hear you, and I hear you on the role that the GSEs are going to play. But consumer debt in the credit space is out of this world. So this whole Muriel, FICO 10 is going to have an impact.
Possible.
So we got 2 minutes. So you got 30 minutes for your 30 seconds for your closing argument. And then I'm gonna turn it over to Perry.
As you can see, well, I think a great place to end it for me is to address the issue of Black and Brown communities. As a member of the Black and Brown communities, I would just say, and in speaking about vulnerability, I think that the conversation I want to have about more effective budgeting, more kitchen table discussions about affordability helps vulnerable people take their power back. Just because the system is unfair doesn't change what it is. It's a contract. It's an agreement. It is a negotiation. And too many vulnerable Black and Brown people are going to the table unprepared. They don't know how much they can afford. They don't know anything about the credit system, and they're relying on the very person that's their opponent, the lender, to tell them. It's very, very odd. And as a consumer advocate, we have to get on firmer ground. And so I can't control everything as it relates to credit policy. I can't control this FICO 10 that's supposed to come out this summer. But what I can do is tell your listeners that it's getting real out here. Get your budgets together. Get your spending together. Start having more cash-based conversations and take your power back.
All right, Perry.
So Perry Flemming, again, the opinions expressed here does not represent my employer or the nonprofit board that I chair of LightPoint. One of the things that we do here in DC as the chair of LightPoint is an accountability group here in the Washington, D.C. area, where we sit down with people and do annual goals, set the annual goals. We work together to do semi-annual snapshot of their finances. We check off their goals on a quarterly basis. On a monthly basis, we're getting together and doing our budgeting and reconciling our budgeting. And then on a weekly basis, we work on our vices and making sure that we're doing a good job managing those. And we use data analytics and technology to improve our ability to manage our credit and our overall financial practices. So I invite you to come out and join us.
Shahidah, how can our listeners reach you?
Well, I'm the proprietor of Shahidah Speaks, and you can reach me at Shahidah Speaks. That's SHAHIDAH Speaks SPAKS at gmail.com. You can also follow me under the same moniker on Twitter and Instagram.
Perry, the nonprofit board that you're with?
You can follow us at Friends of LightPoint DC on Twitter, Instagram, or LinkedIn.
Guys, thank you so much for having this conversation. And as we say at the close of every show, hey, it is your money. You can figure out a pathway. Thanks for joining.
In DC, for DC, DC Radio, 96.3 HD4, and DCRadio.gov.